Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500, and we're going to be talking about something very important in this video, and that is consumer confidence. And we're seeing something happen for the first time in history where the University of Michigan consumer confidence has been moving down very aggressively, and yet the stock market allocation, and this is data from AAII, so this more or less represents how individual investors are allocating to the stock market right now, and it's still relatively elevated here. So we're seeing historical low levels of consumer confidence, but still incredibly elevated allocation to the stock market. So this gap is concerning a lot of investors. It's raising a lot of questions. Why is this happening? What's going to happen? Are we going to see stock market allocation move down to catch up consumer confidence in a big way? And that would trigger a bear market, right? This was 2000. Stock market allocation plummeted, and that brought down the index. Same thing in 2008, 2009. Stock market allocation brought down the stock market. So a lot of people are arguing that this is the reason why we should be expecting a lot more deleveraging in the market right now as stocks catch up to reality. So is that an accurate way of thinking about things? Could we see something different play out? That is exactly the questions that we are going to answer in this video. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. If you enjoy this episode, if you learned something new, don't forget to click on that like button. It does really help push our videos out and makes the effort and time that we put into these videos, it makes it worthwhile. So now without further ado, let's get right into it. So let's start off by seeing why we're seeing such a big gap between what stocks are doing and what consumer confidence is doing. And the first way we're going to do that is by looking at this chart here that highlights the consumer confidence from the Conference Board versus the consumer confidence from the University of Michigan survey. So why are we doing this? Because this chart is also showing the same gap. It's showing that one of the surveys is still pretty high, it's still pretty confident, and one of them is extremely pessimistic. And the reason for that is because the Conference Board survey, so that blue line, puts a lot more weight on what's happening in the labor market. So unemployment rate, jobless claims, and whether or not people think that they're going to be keeping their job. Whereas the University of Michigan survey puts a lot more weight on inflation. And so you can already start to understand why there is this gap between these two surveys. Inflation has been soaring ever since the beginning of 2021, and so we've seen University of Michigan Consumer Sentiment Survey drop down along with that surge in inflation, whereas the consumer confidence that has more weight on the labor market has held up quite well and hasn't been pulled down as much by that inflationary force as the University of Michigan survey. And so if we take a look at that same chart of the stock market allocation versus the Conference Board confidence, the one that's a lot more based on the labor market, well, you can see all of a sudden things make sense. You don't have that gap anymore. According to this chart, stock market allocation is more or less where it's supposed to be relative to how confident the consumer actually is. Now, although it does make a lot more sense, this has still been pulled down a lot by inflation. Now, one of the arguments behind the bearish case for the stock market is that we're in a similar situation to, let's say, what happened in 1973, right here. You can see the University of Michigan consumer confidence was extremely low here because inflation was surging, and yet the confidence on the Conference Board was still relatively elevated. And you kind of had this catch up of the Conference Board to what was going on the inflation side. And you had the same thing here in 1979, right here, where you had the University of Michigan consumer confidence very low, while you had the Conference Board high and then the conference board caught up to what was going on, the inflation story. And this really brings us back to something we've discussed throughout the past few weeks, is whether or not we actually look like we're about to turn into a 1973 or a 1979. So we need to take a look at what's going on in the labor market today, with inflation at extremely high levels and the University of Michigan index being extremely low, similar to these periods. What does the labor market tell us about what's to come, whether we're going to see this type of snap back to reality or whether things are going to get better? Now, what we do at Game of Trades is really try and put the hours and hours of research that it takes to understand the entire market environment completely, and to then be able to understand the odds of making certain bets on certain market positions. We're really trying to pump up our research process, make it as systematic, as data-driven as possible to avoid bias and really just stick to what is the most attractive risk-reward on certain asset classes right now. And all of this research is funneled into a trading watch list, a ratings dashboard, and investment ideas that actually make all of this research actionable, and you understand the positions that we're taking on the market. Now, our entire service is going to be reorganized this quarter to significantly improve that side of the service and how simple and easy it is to apply this research that we're doing across asset classes, whether that's commodities, crypto, stocks, bonds, precious metals, markets around the world. We look for opportunities everywhere. We use our process to research these ideas, and we funnel this into those services that you can use to your advantage. And that is going to include a model portfolio that represents our entire view of the global macro environment. Now, we may have to increase the prices of the membership, so do check out the website if you want to lock in the price of the membership at the current rate, because all members do keep the subscription price at the level they originally signed up for. Back to the debate on unemployment versus inflation, right? We're trying to bring our opinion to the table, to the discussion. We're very open to what you guys are thinking. So if you don't agree, or if you have feedback or criticism, make sure to leave it in the comment section down below. We appreciate all of it as long as it's brought about in a respectful manner. Now, this is a chart of inflation versus the unemployment rate. And you can see, let's focus in on what was going on in the 1970s. And most notably, in this example right here, when inflation was peaking, right, in 1970 right here, and 1974 right here, and in 1980 right here. Let's take a look at what was going on in the labor market. So I'm going to put vertical lines on all of these inflation peaks, and we're going to quickly notice something very interesting. By the time inflation peaks, inflation is already skyrocketing. So back in the 70s, higher inflation rates weighed on the consumer and created a big slowdown, and it made unemployment jump higher. And you can see here today we've had inflation skyrocket, but we haven't seen any signs so far that the labor market is weakening. And in fact, typically when you have inflation come down, and that's accompanied with a dovish Federal Reserve, like you had here after 1974, where you can see inflation was coming down. The federal fund rate that I just added on this chart in light blue was coming down. That is easier financial conditions. And look at what happens to unemployment in dark red. It moves down. So you can see when inflation peaks and the Federal Reserve becomes more dovish, that's good for the labor market. Now, what we believe is happening today is that we're actually experiencing peak inflation. And we've discussed why that's the case in multiple episodes before. And that's just our opinion. You're free to disagree. That's what makes the market. But in general, we think a lot of the forces that we've seen drive inflation here, like low inventories, spiking demand, supply chain issues, supply shortages not being priced in. A lot of that is behind us, and the market looks forward. We don't expect supply chain issues to get worse. We don't expect supply shortages for energy to get worse from here unless you have this big war that sparks. And we're not geopolitical experts, so we're not going to dive into that. But business inventories have been rising, and demand has been slowing for quite some time now. So we do think that disinflationary pressures are acting on the economy right now. And so if that's the case, you could actually see this spike without really triggering this massive spike in unemployment that usually happens during inflation spikes. And so that would build the case that perhaps as inflationary numbers improve, it's going to be a tailwind to the economy. Now, down the road, maybe 1-2 years from now, could we see another great financial crisis? Absolutely. We've seen record amount of tightening, huge spike in energy prices, huge spikes in the dollar, yields have been skyrocketing. That is going to have a big toll on the economy, especially an economy that's over leveraged. But that could take a long time before it happens. In 2006, the Federal Reserve stopped tightening. It took 2 years before the great financial crisis played out. This was a policy mistake. They tightened too much, too aggressively, and created a hard landing. It's very possible that we're seeing the same thing now. But in our opinion, in the short term, cool down in the economy will be seen as a positive for equity market investors and kind of a return to normal. And then perhaps the unexpected drop comes. That's a question for another day. We're positioning 6 to 12 months out. Now, of course, let us know what you think in the comments down below. Don't forget to click on that like button if you enjoyed this episode. Now, in the meantime, I wish you good luck on your trading and see you next time.